Good afternoon and welcome to NAA's first installment of a two-part series on renter history and resident screening practices in a property management context. Today we'll be covering renter history reporting for property managers. You're often asked to play many roles, including serving as compliance coordinators and legal experts. Not fully understanding and adhering to regulations and compliance standards can hurt you and your properties in the long run. Our presenter today, Jay Harris, partner at Hudson Cook, will guide you through the law and regulations that impact your renter history reporting practices, covering a range of issues relating to rent reporting, program design, and compliance resources that can be helpful in your work. Before we get started, I'd like to cover a few table setting issues. First, we'll be circulating a recording of this webinar and the slide deck to attendees in the coming days. Second, today's Q&A session will not be recorded so that you will all have an opportunity to ask questions candidly of our presenter. Next slide, please. So I'd just like to draw your attention to our antitrust compliance and legal disclaimer. And if you have any additional questions, you'll be able to visit the link. Next slide. All right, so please join me in welcoming Attorney Jay Harris to begin today's conversation.
Thanks, Joe. And it's a pleasure for me to be on today. Great to see this turnout. So we're talking today first in a series of two programs that NAA has been good to put on a national basis on the renter history space, this on renter history reporting, another one coming up on tenant screening to come later. And as you are aware, if you're on here, there's been a lot of activity, I think, in the renter history reporting space. Some of you have been at this for decades. Some of the early reporting of positive and negative renter history reporting goes back to the last millennium, where even in the 90s and even before, in some cases, firms were furnishing to the credit bureaus rent payment history information. So there's there's some experience in the space, but it's really been in the last, let's say, 2 years that there's been a renewed focus, some new incentives, entry by new facilitators, businesses to help with the process of facilitating renter history reporting and getting rent payment information into credit reports to help residents qualify for better terms in credit, not just for applying to rent at other apartments, but also for mortgage, auto loans, credit cards, and so forth. So we'll dig into this a little bit today, because on the one hand, there's an opportunity for property managers and the owners that they represent. On the other hand, there are also some risks that it's important that vendors and operators alike are aware of who's responsible and how to react in certain common situations that come up. So as we move ahead to the next slide here, this disclaimer really mirrors what you've heard. I'm an attorney, but I'm not your attorney specifically, so encourage you to consult with experienced legal counsel where you have questions about specific facts and circumstances to your situation. Next slide, please. So what's our agenda today? We'll talk about what's new. As I mentioned, this has been a pretty dynamic area in the last couple of years. We'll talk about some considerations in program design for renter history reporting. There are different participation levels, if you will, that a property manager can have, and different relationships between the vendor and the property management company. We'll discuss those roles and those program design questions. And then we'll talk about some of the resources that are available for compliance and to make sure that data is reported accurately in the rent reporting process. Next slide. So what's new? The motivation here, I think, is unchanged, right? So the opportunity to report rental payment history into consumer reporting. So credit bureau reports provided by Experian, TransUnion, and Equifax as the three national credit bureaus, as well as many other consumer reporting agencies that will use that information in delivering credit reports for mortgage, auto loan qualification, as well as application to other rental properties. Reporting all this rental payment history information is the interest lately has been to score more consumers who have been unscorable and to improve the credit scores of those who have some payment information in there already in their credit profile, from credit information, credit cards, retail cards that they may have, auto loans they may have paid, student loans, and so forth. But to improve the credit scores, and if you will, give credit for the positive rent payment history that they have made that may not have been reported until now. So some of the research out there, HUD has conducted some research along the way. One of their most interesting studies from 2020 found a substantial increase in scores, and both in terms of making residents scorable and increasing the scores of those who are living in public housing authorities. So the benefits can be significant, particularly to those who are less qualified, who are in assisted housing or moderate income unassisted properties, where the benefit of the rent payment information may really be a boost to their ability to improve credit scores and become scorable in the credit process. The Urban Institute and FinReg Lab to Washington, D.C. research houses with a lot of expertise in the credit analysis and housing finance space have done extensive work on finding the right motivations and the right reasons to increase rent payment history reporting, and starting from the conclusion that renters are far more likely than homeowners to be unscorable, to not have a FICO score or a Vantage score that helps price terms they would get for all kinds of mortgage, auto, credit, and so forth. So that's a little bit about the research. I think some of the other exciting areas and some of the stimulus to maybe some of the new entrants coming in the vendor space to rent payment history reporting have been the work that the Federal Housing Finance Agency and the GSEs that it regulates, Fannie Mae and Freddie Mac, have done in the last couple of years to encourage more rent payment history reporting. Today, on less than 10% of the mortgages that the Fannie Mae and Freddie Mac will review, less than 10% have rent payment history information in the credit reports that they use to qualify the consumer for a mortgage. So there's a ways to go in increasing the reporting of this information and improving mortgage terms. So two things have happened, I think, that are important and kind of affect the value proposition, the interest in rent payment history reporting for property managers. One, it has been a multi-year process, but the Federal Housing Finance Agency is now moving to mandate the use of mortgage scores, FICO score and Vantage score being the two leading scores for mortgage qualifications, that actually include renter payment data. For several years, it's been the case that even though well-motivated landlords are reporting renter payment history information, in the mortgage transaction, a mortgage lender doesn't have to use a score that includes any of this rent payment information. That the scores that have been validated for a mortgage originator for the sale of a mortgage to Fannie Mae and Freddie Mac are older versions of the score, and ones which were developed before rent payment information was more prevalent and was modeled more significantly as it is on available newer FICO and Vantage scores. So even though these scores have been available in the market for mortgage origination, there's been no obligation to use them on the part of the mortgage originator. Now that there is, moving in 24 into 25, now that FHFA has validated the newer FICO and Vantage scores, there's more benefit to the resident and to the property manager in reporting this rent payment history information. More likely that the reported information will be used by the mortgage originator or the credit card or auto lender in the process of qualifying a rental applicant. Similarly, Fannie Mae and Freddie Mac on their own have seized on this initiative, and as part of their equitable housing policies, are providing incentives for single-family and multifamily operators to report rent payment history information through facilitators that each of these GSEs have identified. These financial incentives and original research that Fannie Mae and Freddie Mac have done are helping hundreds of thousands of renters at thousands of properties improve their credit terms across the country. So we'll dig into that in a little bit. I think the other point we'll talk about as we go a little farther is activity on the data standard side with the Metro 2 credit reporting guide, which for the first time has addressed some of the lingering questions about the proper way to report rent payment history in furnishing to the credit bureaus. We'll get to that. Next slide. All right, so I mentioned Fannie Mae and Freddie Mac have really been catalysts in this area. From their numbers, they've found that well over 500,000 units are participating in their positive rent payment reporting program. And the increase in credit scores, or the ability to score renters who did not have a credit score before, has increased significantly. Fannie Mae, on the latest numbers that they published, has over 400,000 multifamily and single-family rental units participating, 250,000 consumers reporting, and nearly 60% of these consumers who are in a rent payment reporting program are seeing an increase in their credit score, with an average increase of up to 40 points. And similarly, another 23,000 renters are establishing credit scores that weren't there before. Freddie Mac, a similar success story in having 150,000 participants. This data is a little bit older, so my guess is they're over 200,000 now. And again, 20% of the renters who joined this program for rent reporting through a Freddie Mac incentive program, a property that is under a Freddie Mac loan, 20% of the renters are establishing credit scores who weren't able to do this before. At the same time, each of these agencies have also created processes, more flexible processes, to take rent payment data directly into mortgage underwriting, not simply coming in through furnished credit reporting through the credit bureaus, but also taking manual data that could be provided by the consumer or the lender into their desktop underwriting and loan product advisor processes. More flexible underwriting to get at more rent payment data and give the benefit to residents of their positive payment history. And I think importantly, as we talk about in the program, that both of these are programs that have made a conscious decision to encourage the reporting of positive payment information only, right? So the renter who is late on payments, that individual, under these programs, just the positive payment information is being reported, and it does not give a full file result of some of the derogatory late payment information that where the renter's been late to pay in the program. And I think that's important because in many cases the property manager is interested in getting a full file for the purposes of understanding if an individual has a derogatory payment history at prior properties. In the tenant screening process, this can be an important thing to know. And similarly, for modeling purposes, it helps to have a full file in many cases. But be that as it may, the growth has coincided with the growth in furnishing and providing this information has coincided with a focus just on the reporting of positive payment information. And we'll talk a little bit more about that as we get to program design. Next slide, please. So one organization that's been in the space, TransUnion, is one that's done some recent research here. And some of the information I think is important as property managers think about how they might participate in a program to facilitate rent payment history reporting, both for a renter perspective. The renters are more likely to pay on time if they know their rent payment history is reported. The consumer understands the benefit to improving their credit score, but they also know and are aware of the fact that more attention to their payment history may motivate them to stay on time with their rent payment. And similarly, renters say that as they're shopping and looking for a place to live, that nearly 60% are more likely to rent from a housing provider that talks about and reports rent payment information. So we see a marketing benefit in this, not simply an operations bad debt reduction motivation by rent payment reporting. Why do the housing providers participate? Overwhelmingly, the ones who are participating, the property managers, are interested in helping renters build credit. And then to a lesser degree, but still significant, slightly more than half housing providers are encouraging renters to pay on time. And then about a third want to attract renters who are fiscally responsible. So all of these motivations add up to, as I mentioned, a very dynamic area that, and this was the stat I think that stood out the most to me, that half the property managers who are reporting rent to the bureaus began this work in the last couple of years. So it's been a very dynamic area, new value propositions, new ways to get data into the credit reporting system, and a lot of, therefore, new questions about how to play that property managers are feeling, both from their owners as well as from their residents. Next slide, please. So let's talk about some upfront program design considerations here. There are, as I mentioned, different ways for the property manager to play here, right? Much of this growth has come from the property manager taking the role of the furnisher of rent payment information out of its property management software system through a vendor to one or more of the credit bureaus, if you will, a traditional furnisher relationship. There's also increasingly a role for the property manager to promote a consumer-driven approach in which the property manager is not furnishing its own data, is not the furnisher of record, but is marketing and making residents aware of the ability for the residents to go to one or more vendors and share their payment information themselves directly with the credit bureaus. In order, motivated to build credit, residents have shown that they're willing to pay for the ability to get their rent payment information reported, and are willing to do that even if the landlord chooses not to participate as the furnisher of record, but merely to market this as an option to residents at its property. So both the furnishing approach, where the property manager and the name of the property is on the furnished data, or the facilitated approach, where the consumer is identifying and pushing its payment information through a facilitator, a third party, have grown significantly in the last couple of years as residents are looking to improve their credit profiles. The other question, as I mentioned, goes to the positive only or full file furnishing. If a property manager is thinking about which to do, recently positive only reporting has been significant, a lot of growth in that area. And yet, we can look back only a couple of years ago when we had significant derogatory and overstayed residents living in properties and bad debt concerns. And many housing providers were concerned and looking for ways to report both derogatory and positive payment information to accurately portray a resident's true payment profile, because their bad debt was significant. And in particular, residents who had $5,000 and $10,000 and $25,000 debts owing for long-term stays in properties after breaking the lease. These were situations that landlords wanted to make sure they had visibility into, and absolutely wanted to report accurately this derogatory information. So while there has been a lot of growth in positive only rent payment information for credit building purposes, it's important to recognize that the full file furnishing alone is going to give a full picture of the resident's profile. And some of this happens already, and we should talk about this dimension here, that third-party collectors representing property management operators typically are reporting unpaid rent and damages, and do this as part of a normal collections process post move out. So in evaluating an overall role in the rent reporting system, property managers ought to look at and make sure they're aware of disputes and questions and the accuracy of information that's reported not only by themselves, but also by collection agents, as well as vendors who may be participating in helping deliver rent payment reporting information. It's not uncommon to see a situation where a landlord is offering positive only rent payment information from one of its vendors and is reporting derogatory information, accurate in both cases, about another vendor through another vendor about prior residents in the property who have had bad debt issues. So in evaluating the role, it's important to think through and stay on top of both the derogatory and the positive payment information reported about residents. Another common question is whether in setting up the program, there are requirements or there are business preferences for having the resident opt in to reporting their rent payment information to credit bureaus, or if it should be set up on a default basis with the opportunity for the resident to opt out of the program. And related to this is the question of the resident who drops out, whether there's a waiting period that they have in order to get back in the program if they've had a derogatory experience, but then want to resume paying on-time payment information. General answer is that there are not prohibitions on setting up a opt-out program, whereas on a default basis, renters can have their rent payment history and information reported. This is fairly common in market rate. The take rate, the benefit to the consumer and to the landlord is much greater where the default decision is set at joining the program with an opportunity to opt out rather than the other way around. So we recommend this as a way to go. There are some questions that come up from time to time in the affordable housing situation. And in this circumstance, it's important to work through with a vendor you may work with to make sure that there's the appropriate compliance for this program. But in my experience, working with affordable housing providers and market rate operators across the country, we see it's fairly common and have not seen objections by HUD or local regulators, even in the affordable housing case, to have programs set up on an opt-out basis. It's important to have good, clear disclosures to be able to answer questions that the resident has about how to participate in the program and what the benefits and consequences are. But by and large, the opt-out approach, default setup for residents with clear notice and authorization, tends to be the dominant form of participation for rent payment reporting. As it relates to the resident drops with the greater attention to positive payment only information, we see that where residents have a tough time in making the rent, they may want to decide to drop out of the program, not report information for a time when they're going to be late on their rent, and then try to re-enter the program immediately. And so in some cases, we see operators have set up a waiting period to make sure that the individual is able to motivate continued participation in the program, continued paying their lease obligation on time, and there may be a waiting period of 3 months or more to re-enter a positive rent payment history program where an individual hasn't paid on time. Again, talk to your vendor about this feature and see if that fits with the kind of property that you have. The last design consideration, and then we'll talk a little bit about the relationship between the vendor and the property manager. I think the last design consideration I wanted to talk about was just the realities of the residents you have of the property and the market you're trying to hit and the level of effort that's required to encourage participation in the program. For those residents who stand to benefit most, sometimes the effort to get them to join the program and to extend and encourage their participation, maybe the more labor intensive as you move down the income scale, move down the rent scale. So in my experience, having worked on the board of nonprofit housing providers and having advised and worked with operators around the country, it is not uncommon to see on tax credit deals or market rate affordable properties, older properties, that depending on the resident mix, some of the digital barriers, the likelihood of participating through an online directed program may be more significant than they are for your average market rate newer properties, and more effort may be involved on the part of the vendor and the part of the property manager to extend and answer questions, encourage participation in the program. That sending out a series of emails alone isn't going to drive participation in the program, isn't going to deliver engagement and setup in online resident profiles that's needed in order to get enrollment in the program. Similarly, language limits can be an issue at some properties. And similarly, even where the language limits aren't there, just the overall trust issues about the value proposition that reporting rent payment information is going to, or is likely to, help increase the credit profile and improve credit terms that may be available to a resident, that value proposition may take some trust building exercises that, in my experience, can be fairly labor intensive sometimes. So it's important in looking at projected participation levels and the supporting materials, FAQs, education of residents and of staff who are helping to support this program. It's important to look realistically at the resident mix in preparing to answer these questions, both by property management staff as well as by vendor staff. All right, so let's move on, if we can, to the next slide here. We want to talk a little bit about the relationship between the property manager and the vendor. So generally, established vendors in the space who've been doing rent payment history reporting for decades, as well as newer entrants who have entered in the last several years, are by and large fairly savvy and sophisticated about making a new rent payment program work, given the time constraints of the typical property management operation. Increasingly with property management centralization, with additional demands on resident property management staff, it's important that you look for a vendor who's going to be able to support clearly in several areas, and also interact with good numbers and detail, useful reporting for the property management company and for renters, so that there's clarity into program participation and the value proposition to the renter. So, in the typical relationship where the property management company is working with the vendor to encourage rent payment reporting, and the property manager is the furnisher of record, often the vendor is playing a key role in renter outreach and enrollment. Property management staff often will support the vendor's work in contact with the residents by email and by phone. Resident staff, property management staff, are educated in recurring questions, some of which can be referred to the vendor, some of which can be answered at the first line level by the property management staff. But that renter outreach and enrollment is really important, given the novelty of and complexity of the issue that we're talking about here. Since depending on the resident mix, in some cases, this isn't necessarily an intuitive discussion, one which with some education, a resident can understand the benefit, but one which has some complexity going into the conversation. So good outreach, good enrollment support from the vendor, even in an opt-out situation, is going to be important to success of the program at the property. Similarly, on reporting the information, it's good. Vendors have, sophisticated programs in place to ensure the accuracy of the information that they're pulling out of property management software and sending along to the credit bureaus, the national credit reporting agencies. I think here the key point is to make sure that there is a good conversation going on with the property management company about any the accuracy of this information, what to do in the event of any disputes that the consumer may have over this information. Where it's positive payment information, we find that the dispute rate, as you might expect, is greatly reduced. Consumers typically are concerned about derogatory information, and in the absence of derogatory information, we find the dispute rates go down significantly. But in the arrangement where the furnisher of record is the property management company, and the work is facilitated by a vendor at its direction, even though the vendor is relatively sophisticated, it's important that the property management company is able to carry out and understand its duties to review and be aware of the accuracy of the information that's being reported to the credit bureau. So with good reporting from vendors that are in this space, property management companies can stay on top of the fact that information is being reported. And to the degree there are questions about the accuracy or the frequency of the information that come up to the property management company, they're able to get good answers to the accuracy and completeness and the integrity of the information that the vendor is sending along to the credit bureaus. Ultimately, the exposure is on the part of the furnisher. The vendor often will play a delegated role, but importantly, the property management firm should remember that they cannot delegate the liability entirely in the contract, that it's the name of the property that's going to be on the credit bureau report in many cases. And therefore, if there are concerns or disputes over the accuracy, it's going to be important to understand what sort of monitoring is in place in the event of complaints or disputes around the reported information. So do we see a lot of disputes? No, as a group, we don't, but it's something to watch for and keep an eye on. The other related issue, I think, that goes to the broader value proposition that many quality vendors are bringing to this issue of renter history reporting are ancillary services that may be offered to residents in addition to rent payment history and reporting. So there may be additional benefits that come with this. That could be everything from credit monitoring to additional benefits or discounts on other offers that the vendor is able to make available through its network to residents of the property. Property operators ought to be aware of the scope of these services that are being offered. And it's nothing wrong with it, fairly common practice, but it's important to understand and recognize the degree to which renters are getting additional offers at the property from vendors who are involved in renter history reporting. In terms of the oversight, I mentioned the furnisher accuracy. I wanted to take a little bit of time to turn to some of the documentation in this space that has been around for a while, isn't new, but maybe new to those that are new to the renter history space. And so with that, let's go to the next slide to talk about some of that, some of the legal side of this. I won't go into in the interest of time, I'm not going to go into great detail. A copy of this will be available, and happy to take questions if there are additional questions about this. But the law says this, and we'll talk briefly about Reg V, and then also talk about the CFPB's most significant step into renter history reporting with its enforcement bulletin from 2021. Regulation V under the Fair Credit Reporting Act governs the documentation that is expected of a furnisher of payment information, whether it's a credit card furnisher, auto loan, whoever is furnishing data to a credit bureau, whether they're doing it directly, like a big credit card issuer, or indirectly through a vendor, like a property management company often will do. And these obligations are to to make sure that the information is accurate. It's furnished with good documentation to back it up. There's an obligation to reinvestigate disputes that come up with from consumers, and to the degree that there is inaccurate information that is being furnished in the name of the property, to correct and update that information if it's necessary. Where there's identity theft that is alleged with some substantiation, then there's a affirmative duty to take action to stop sharing this information on the part of the furnisher. And on the administrative side, obligation to educate staff and have appropriate controls and vendor oversight are obligations of the furnisher. A periodic annual or biannual self-evaluation of the policy in this process is, under the regs, something that a furnisher is expected to do in order to stay on top of the integrity of the process and the way in which it's being implemented operationally. There are several more pages describing these obligations. I recommend that property management companies considering entering into becoming furnishers in the space, working with a vendor to do this, or even do it directly to one of the bureaus if they're of some size. Make sure that they work with experienced counsel who are up to speed on these documentation obligations for furnishers. They don't have to be particularly complex necessarily, but you do need to have documentation in place and ongoing regular self-evaluation of the process to make sure that data that is furnished about residents is accurate, and that dispute processes are in place to handle any questions that come up from residents who have a dispute with what's been reported about them. And these are the two topics that were of interest to the CFPB in its one enforcement bulletin on rent payment history and reporting. This is one that came out during the COVID era in July of 2021. And the key thing here is that as it relates to accurate reporting, in the eyes of the CFPB, it was important that what was reported as owed was excluding any impermissible charges. In this case, late fees, but also similarly other charges that may be in violation of state or local law. The CFPB said that it was important that to be accurate, it meant that the furnisher was not reporting illegal information, amounts that could not be substantiated by the paperwork, by the lease, or were in violation of the applicable law. Similarly, as it related to dispute reinvestigation, there was the obligation of the furnisher to make sure that if there was a dispute, again, over typically over derogatory information, that on a timely basis, the housing provider could provide documentation that supported its view, could, to the degree that was necessary, update and correct information if, for example, claimed damages could not be substantiated with the paperwork that was still in the file for a resident who moved out a couple years before, and correct information to reflect the documentation that the furnisher had. And this hasn't changed. This continues to, these two topics, accuracy and the obligation for thorough dispute reinvestigation, continue to be of interest to the Biden administration's CFPB, the Consumer Financial Protection Bureau, under Rohit Chopra, and not just for rent payment reporting, but for furnishing data in the credit reporting system generally. So I encourage you, those of you who are already in a program where you've been furnishing for a while or entering in a new one, to make sure that you're on top of consumer disputes and the documentation that you may have that supports the accuracy of the information that you're reporting. In the old days, perhaps you could claim that this was the amount that was owed based on what it said in the property management software system. Today, the need and the expectation, if there's a dispute, is that you are able to point to the lease and other disclosure documentation that backs up the charges that are in in the reported amount. Next slide, please. Last bit we'll talk about here, I will talk about, and then we'll open it up for questions. It goes to those of you who are working with vendors and want to understand a little bit more about some of the technical areas, or those of you, and I see there's some of you on the call who are working with some of the property management software systems, and get questions from time to time from property management clients about what's appropriate to do in this case. So the Metro 2 is a industry standard, a consensus organization that is comprised of credit reporting, consumer reporting agencies, and the furnishers that participate in this space. For decades, they have put out guidance to help address the way in which debt is depicted and payments are depicted in the credit reporting system, not just with the national credit bureaus, but downstream with any user, credit issuer, or other housing provider who's using a consumer report. So this consensus-based approach, until last year, had not addressed rent payment reporting. For the first time in 2023, the credit reporting guide now has a new chapter, chapter 12, that builds to the general principles in Metro 2 guidance for rent payment reporting. And some of the highlights here, again, we won't go into great detail, but happy to talk about this in the questions or handle specific questions offline. But some of the clarifications go to the treatment of a lease about in the credit reporting system, whether this is treated as an open or a closed account. This was a situation where, depending on how it was characterized by a credit modeling firm or a credit reporting agency, it's possible that in reporting a lease, it could look like a new loan obligation, and a new, it would actually be a negative impact. A new lease would be a negative impact on one's credit score initially until it was paid off, whereas reported as a closed account. This guidance clarified that leases should be reported in the credit reporting system as open accounts, and removed a problem that was in place with some methods at the time of an initial derogatory bump from starting to report certain lease information. Similarly, the situation where there are multiple tenants and the tenant of record changes as a lease renews, people move in and move out in, for example, the student housing format, or a renewal where a third person moves in, and now you have 3 responsible for the rent in the second year, but only 2 are responsible in the first year. Without getting into the weeds, issues like this are addressed in the Metro 2 guide. And similarly, the other thing I'd point out would be voucher tenants, where a question existed for a while about whether the right amount to report on a housing choice voucher holder, a Section 8 voucher holder, was the full amount of the rent, or just the amount that the resident was responsible for, net of the voucher. Again, some consensus in this Metro 2 guide that the tenant responsible portion, net of the vouchers, is what's the appropriate amount to report in this situation. So technical issues, but ones in which there was not consensus before. And I think importantly, the industry, with participation from some housing providers, some property management software companies, some facilitators and furnishers in the space, and the consumer reporting agencies, were able to come up with some consensus guidance without the need for legislation or regulation. So I commend this effort to you, for those of you who are spending some time in the space. The source is available here, the Metro 2 source, through the Consumer Data Industry Association. The link is there at the bottom. But for those of you who spend some time and are wanting to make sure that you've got the proper, you're pulling the proper data in the system and characterizing the right way in which you report to the bureaus, I commend you to take a look at the credit reporting resource guide from CDIA and Metro 2.